In this lecture, we will continue forward with the concept of the interest rate corridors. And before we get started on the interest rate corridors, let us recollect. In our last class, we had discussed as to how the commercial banks hold exchange settlement accounts with the Reserve Bank. And at the end of each day, the banks settle their transactions with each other through these accounts. So different banks have to be paying money to each other by the end of the day, and that kind of a settlement of these accounts at the end of the day is settled through the exchange settlement account. And we had talked of it that this exchange settlement account is primarily the account that the commercial banks hold with the Reserve Bank. And the market, or as in at the end of the day when these accounts are settled, we call that as overnight money market or the short-term money market. Now, by the end of the day, there is a possibility that some banks would have surpluses and some would have the shortages of funds. So the banks that have a surplus could keep that money in this exchange account, settlement account for that period at a certain interest, and that interest rate is called the cash rate. So what is this cash rate? In the simplest possible words, as we have discussed earlier, just like individuals or households or the firms pay interest rate to the commercial banks, likewise, the commercial banks have to pay the cash rate to the Reserve Bank, or if at all they borrow money from each other. So putting it up on the fact here, that is cash rate is intra-bank interest rate or the interest that they pay to the Reserve Bank. That's that easy to remember. You can see that is explicitly here. Now, what is this interest rate corridor? I had suggested that this interest rate corridor relates to how the Reserve Bank maintains a certain level of interest in the money market. We have discussed it before, that is the cash rate. This cash rate is, let us get going again back to the previous one first one more time. We have already discussed how all the banks have an account with the Reserve Bank, right? So these accounts are called exchange settlement accounts. And at the end of the day, each bank has to be paying to the other and so forth. And just for the sake of example, I've taken it. Let's say there are two banks here, Bank A and Bank B. Bank B at the end of the day is left with a surplus of funds in the overnight money market, all right? And Bank, as you can see it here, Bank A with a surplus of $1 million here. And this Bank A can have two choices. It has got two options. Option one, that it leaves its surplus with the Reserve Bank in which account? Yes, in the exchange settlement account that it has with the Reserve Bank. And Reserve Bank would offer it certain interest. Okay, that is 2.25% for our example here. On the other hand, there is another option for this bank because it has got surplus. Number one, it could leave the money with the Reserve Bank in its exchange settlement account and get some interest from the Reserve Bank, as in 2.25%. Alternatively, this bank can actually loan out some money to the banks, whichever has a shortage. So it could lend the money in the overnight money market. On the same lines, Bank B, say for instance, has a shortage of $1 million. What this bank could also do, pretty much the same, because we have said Reserve Bank is the banker's bank, and thus this bank can borrow some money from the Reserve Bank. As in an example here, it can borrow from RBA, let's say at 2.75%. Alternatively, it could borrow the same money from the banks which have got a surplus in the overnight money market. So how does the corridor gets to be built with this? When I'm just talking pretty much the options that the banks have, bank with a surplus has an option of leaving this money as a deposit with its own bank, that is the Reserve Bank, or lend it out. Likewise, Bank B, if it has shortage, it has the same option like an individual, borrow. Borrow A from Reserve Bank or from the overnight money market. And in this overnight money market, you also have Bank A, right? Reserve Bank does a very smart job there. Whatever interest rate it wants in the market to be prevailing, it just tries to keep 0.25 basis points lesser from the market rate on the deposits and 0.25 basis point above on the lending. And therefore, the interest rate corridor in principle is the difference. It is the difference, if you really look at it, between the Reserve Bank's deposit and lending rates. And as we have said, it is a plus 0.25 and a minus 0.25 basis points. So plus 0.25 more than the market rate. So when the Reserve Bank has to lend money, it asks 0.25 more than the market rate. And on the deposit, it offers lesser than what it wants. So in this example, you can clearly see that if the Reserve Bank wanted the interest rate to hover around 2.5%, let's say, what it could do, it has kept an interest rate on the deposits at 2.25. And on the lending, it has got the interest rate at 2.75. This is its official cash rate. Okay? Like a maximum or a minimum price ceiling and a price floor, if you remember. So here it is the minimum on borrowing according to it, and it is the maximum it will give. You understand? Minimum is 2.275 on the borrowing, and maximum in terms of the what it has to give, it is putting it like a floor that it'll give. Sorry, it's putting it like a ceiling that it'll not give any more than 2.25 on any of the banking things. So if you understand this here, goes without saying, if a bank has a surplus, and if you were, let's say, the CEO of this bank, and with this surplus money, you had two options. Option one, let it be with the Reserve Bank at 2.25, or lend it out in the overnight money market at 2.5. And remember, the banks are not dealing in hundred thousands or millions. They deal actually in billions of dollars. So even 0.25 matters. So in this situation, definitely Bank A would rather want to loan out the money in the money market. So it's a win-win situation. We'll see how for both. On the other hand, if the Bank B has a shortage, it could borrow money from RBA at 2.75, which is definitely being here more. And alternatively, it could borrow money on a lower interest rate in the money market. So again, if you were the CEO of this bank, you would say, I would rather buy it from the market because this is cheaper, this is lower rate. So this is typically what happens in the real money market, and therefore the interest rate corridor gets set in, and the interest would now hover around. If I have to put it up, the range would be between 2.25 to 2.75. So what's the range? 2.25 to 2.75. And remember, as I said, 2.25 here is what? It is saying it will not give any more than, no more than. It doesn't give anything more than the deposit rate. And what is that? No more than 2.25 is the rate here. No more than means, no more was, can you recollect? Price ceiling. So it's the maximum price, maximum cash rate. It says no more than. I will not give more than 2.25 as the cash rate. And then here, if you look at it, it is, we will not take any less than. So no less than. So this is your minimum price. The minimum interest, maximum interest. And naturally, if anyone gets a better deal in between, would be interested in. So this is where the interest rate corridor has come in. So whichever way the Reserve Bank wants it to settle. The next figure clearly shows here to you that how the Reserve Bank actually would ensure that the cash rate hovers around between the lending rate and the deposit rate that the Reserve Bank has chosen to keep it at. So the Reserve Bank announces the new target cash rate. One more time, I repeat the process for you. And then the Reserve Bank then resets the interest rate corridor. And this means that it increases or decreases within this interest rate corridor. Now, if it wanted to reduce it, let's say, if it wanted to go for an easing policy, if it wanted to reduce it by 0.25, as you can see, that the Reserve Bank can just change the lending rate and the deposit rate. So what has it done here now? Its lending rate has been reduced to 1.5 by 0.25 basis. So from 1.75, now it has come up to 1.5. And on the other side, on the deposits, it has again reduced it further. So from 1.25 to 1. So now the interest rate will by default set somewhere around 1.25. If your visual senses are good, maybe you would be more comfortable learning it this way. You could see this was a higher interest rate before. And then it wanted to set a target, lower target. So what it did was it actually reduced it. And from here, it actually increased it. So the interest rate on the lending and on the deposits come out to be settling somewhere in this range. And that's what we've said in our previous figure. What did we say? That it is the difference between the RBA's lending rate and the deposit rate. So this is the lending rate, this is the deposit rate, this is what it is. So if I want to bring it down, it's very simple. Here it is. Here it is. Yeah? Sorry, I have drawn a wrong line there, but yeah, this is how it is to be able to come to the conclusion. That is, it would just go further down onto this line, and thereby the interest rate would be lower now. So automatically, since the range, in other words, if the range is changing, the interest rate would change. So we've changed before it was here, and all we did was reduce both the ends. So if nothing gets into your head, the best way of remembering is that you're actually, the Reserve Bank actually changes the very range. So if it wanted the interest rates to begin with at an earlier point, it was looking at 1.2, at 1.5. So it had 0.25 above on the lending, and it had 0.25 below at the lending. Right now, it wants to settle it at a different level. Let me just change the color of my pen. That's the issue, that I'm not able to change it here. So now if it wanted to change it down, you can look at it that it brings down the interest rate on, sorry, just moved on here. So it just brings down the lending rate and the borrowing rate. Then it's, and this is typically what it does during an expansionary policy. Expansionary monetary policy, let us try and recollect what is expansionary monetary policy and when is it implemented? Yeah? Yeah, expansionary is when the goal is to expand the economy. And how do you expand the economy? And why do you expand the economy? That's the question. The reason for expansionary economy is expansionary monetary policies, mainly because when the economy is going down, remember, we talked of it, be it monetary, be it fiscal policy. The goal is to improve the economy from its current state. And that's the reason that the policy measures are counter-cyclical. So when the Reserve Bank goes in for an expansionary monetary policy, as you can see here, it would actually reduce the cash rate, just like in our previous example. So if it reduces the cash rate and brings it down, the advantage would be, because cash rate is the cost of borrowing for the commercial banks, it would mean that that cost is going down for them, and therefore they're likely to decrease the interest rate because there's more money available, more funds available with them now. It's just the same kind of a story, folks, that if commercial banks have to repay lesser, they are left with more money, right? And just on the same stance, same scenario, if they have more money here, that means they can afford to charge you lower interest rate. Now, two things that happen when the interest rate goes down in terms of a flexible exchange rates regime. What happens is that the economies can have this impact, that is the hot money. And what's that hot money? The money that moves from places to places in the search of better returns. So if the interest rate is lower, people would not want to keep the money in Australia, would not prefer to, the investments would be less attractive in that sense. So money is likely to move out to the places, to the destinations where there is a better interest rate available. And that would mean the changes in the very demand and supply of the Australian dollar. And that could mean that the exchange rate would go down. And on the other side, because interest rates are lower, the cost of borrowing for the households have gone down. Therefore, the debt repayments decrease. People will have more savings, and thus, will have lesser savings because the interest rates have gone down. So they would be rather interested in spending and investing, and thus the investments would go up and consumption would go up. And we have done all this, how the interest rate affects the consumption, how the interest rate affects the investments very clearly in our earlier chapters. And therefore, the net result in this case is more of C, more of I, and also when the dollar value depreciates, things become cheaper, and thereby people would find it more attractive to buy goods and services from Australia, and thereby the net exports would go up, and hence a total increase in aggregate demand. We can even sum it up in different ways. So this whole effect can be put up as savings and investment channel. It gets transmitted into the economy. So saving and investment is because interest rate influences economic activity by changing the incentives for savings and investment. So a reduction in interest rate on deposits reduces the incentive to save money. This is precisely what I've been saying already, right? So again, I repeated that this is the section I'm referring to. So the savings will decrease, and so will the consumption would increase, because now you're left with more money in hand because your debt repayments have gone down. And also, in our earlier lectures, we have done it, how and lower interest rate means more investment because cost of borrowing is less. Not only this, it can affect the aggregate demand further. And how does it do that? Let us look at it. The when the it takes the aggregate demand. We have already said that anyways, that how the aggregate demand has increased because of the decrease in the interest rates or the cash rate. And this increased aggregate demand, of course, we know it that it can take a while for the supply to respond that quickly to the increased aggregate demand. And because the workers, equipments, infrastructure may be required, and it does take some time. So aggregate demand initially can go up and can be more than the aggregate supply, but eventually the aggregate supply should adjust, and thus the new equilibrium attained. And as the businesses increase their prices more rapidly in response to the higher demand, you would see that there would be a little bit of demand pull inflation. That's a possibility. And the next is relating to the, and if the dollar depreciates, there is a possibility that we may have greater bill in terms of our imports for any of the goods and services, because the dollar is carrying a lesser value there, right? So it can have a lot of effect on the economy, and it can even affect the inflationary expectations, because if the workers expect inflation to increase, they might ask for larger wage increases and thus fuel the inflation as a problem. So it is a very, very balancing act, very well thought and a careful way of doing things. And just in contrast is the contractionary monetary policy. The Reserve Bank does just the opposite, as in it increases the cash rate so that the commercial bank's cost of borrowing increases, the hot money moves in, and thereby also alongside the interest rates go up. And when the hot money moves in, the demand supply is affected, and thus the exchange rate appreciates and the net exports will decrease. And the cost of borrowing for households and the firms will increase with the increased interest rate. So people would rather choose to save more, and the debt repayments become more, and thus the spending is likely to go down. And as the aggregate demand decreases, there is the decrease in the economy, income, output, employment, and the main goal is decrease in inflation, because we have said that the Reserve Bank's goal is to monitor or target rather the inflation. Trends of the monetary policy. First of all, it is quickly implemented because the target rate of monetary policy can be changed at the monthly meeting of the Reserve Bank Board. So every month when it meets on Tuesdays, it can, on the first Tuesday, in fact, it can, take a policy action very quickly, and it's an independent body on the top of it. So, which is a very strong point for monetary policy. It's more of an independent one. So, and the Reserve Bank Board announces changes in the settings for monetary policy to the media, and media announcements and speeches by the governor of the Reserve Bank are released. So, it is one of the transparent policies, and it does bring in a quick clarity to what's likely to happen. And such announcements are usually, they do explain the reasons for any change in the monetary policies. It is very, very transparent in nature. And also it is very effective during the boom. It has proven to be effective in boom in terms of controlling the inflation. It's very effective in reducing the level of aggregate demand and credit. And mind you, this is one of the reasons, one of the key goals of the monetary policy is to target inflation. And what are its weaknesses? Oh, well, it is a blunt instrument because it affects aggregate demand across the economy. Many people are affected, in the same way, irrespective of what their income level is and where, at what, in what income bracket do they fall. Because if they've got a mortgage to pay and if the interest rate goes up, there is no no respite. Everyone has to is kind of equally treated. Some people may consider it as a merit, but it is blunt and it could be harsher, especially on the poorer segment or the middle income groups. The time lags, of course, some estimates suggest that it takes between 1 and 2 years for a monetary policy to have its maximum effect. So it is again relatively slower, and it is ineffective in recession periods. Yes, it is very easy to control the inflation relatively with the monetary policy, but the effectiveness of the monetary policy is very low when it comes to the recession. The sources people for which you could actually refer to is the Reserve Bank of Australia. Do go on this website. You have got far more details. And that's it for this particular lecture. And in the next.